When a stock chart pushes higher in a steady climb, the green candles suggest strength. However, relying on price alone ignores a critical variable, the internal energy required to sustain that movement. Consider a runner in a full tilt sprint. While we can easily track their speed across the ground, the external view doesn't reveal the exact moment their muscles will lock up from exhaustion. Predicting a sudden slowdown in the market requires a way to quantify the hidden momentum driving these price changes. The Relative Strength Index, or RSI, provides this internal metric by calculating the velocity and magnitude of recent price movements. Identifying which side is losing the underlying war between buyers and sellers is the most effective way to anticipate a price crash before it begins. To find this momentum, the indicator isolates market behavior within a strict mathematical window of the last 14 trading periods. This chart highlights 14 candles, focusing exclusively on the 8 positive upward movements. Moving up 8 times resulted in a total combined gain of 40 rupees. The formula divides that 40 rupee total by the 14 periods, producing an average gain of 2.8. This figure provides a concrete mathematical value for buyer strength over the last 2 weeks. Now we look at the same window to determine seller strength. We isolate the 6 downward moving candles. During these negative sessions, the price dropped by 28 rupees. Dividing that 28 rupee loss by our 14 periods gives an average loss of 2. This leads to the relative strength ratio, or RS, a direct head-to-head comparison, placing the average gain of 2.8 over the average loss of 2. This ratio reveals exactly how much momentum buyers have compared to sellers. However, raw fractions are volatile and difficult to interpret quickly during a live trading session. To make the data usable, the final RSI formula converts this ratio into a standardized score locked between 0 and 100. Relentless price increases push the RSI line toward 100, while constant drops drag it toward 0, making the shift in momentum visible. When applied to a chart, the RSI sits below the price action. Traders monitor this line for movements toward 2 specific limits. On this chart, when the RSI line crosses the 70 mark, the asset enters the overbought zone. At this level, the data suggests buyers have reached a point of exhaustion, significantly increasing the probability of a downward reversal. Conversely, when the RSI line drops below the 30 mark, the asset is considered oversold. This indicates that sellers are losing momentum, often signaling an upcoming upward move. RSI translates market behavior into a mathematical measure of fatigue, identifying the specific conditions where a reversal becomes a statistical probability.